Hey everybody, welcome to this free edition of our Trader User Group, a weekly roundup. This is for the trading week ending Feb 18, 2022. I'm Preston Brent. Thanks for tuning in. Bye-bye, easy money. As it flies away, we're going to shift the regime of the market environment here over the next decade, probably 2 decades, because we've run out of easy money, which really kind of started in a way in the dot-com era, the year 2000, and then we slowly started to tighten a little bit, but going into 2007, 2008, away we went again, and we've been in cheap money ever since. But I think this era is going to slowly come to an end, and as we go into the 20s, into the 30s, the returns that we're going to see in the S&P and most major U.S. indexes are going to be a lot lower than they've been. It's going to turn more into a stock picking regime, or if you really understand options and how to take advantage of this, it's going to be a great time for us. So why don't we just take a look at where we've been this past week and how things are starting to shape up. So let me just go in and let's take a look at this past week. Let me just move this over like this, and let's get the index performance up here. So here we go. So if we look at this past week, you can see everything is in the red, both weekly and year to date. Both NASDAQ and Russell are in an official correction territory this year. Some of them coming closer to a bear market, which I'll show you in just a minute. You can see the valuations here. The forward PE is 19.69. It's still the highest valuations we've averaged since the dot-com era. All right. Markets have gotten away from themselves over the past couple of decades, and I do believe over the next 20 years, 10 years certainly, and we're going to see volatility come back for sure. But, with the easy money policies being pushed over the economy or into the economy for the past 20 years or so, that's gonna slow annual growth as we take some of that money back out. Okay, you can see the forward PE is at 19.69. Dividend yield for the S&P 1.39%, 10-year Treasury at 1.93. So that's higher by 55 bips or basis points, a little over a 0.5%. Earnings yield for the S&P is at 4.72%. But you can see the S&P yield over 10-year Treasury, 2.79%. But the real yield, when you take into account inflation, is still underwater at 4.71%. So that does force money to take higher risk than it normally would. Current VIX, you can see it was up for the week, just slightly, 1.4%. But still, all in all, not a very good week. Best performing sector was a value sector, kind of the staples. XLP is up a little over 1% for the week. Worst was energy. We're seeing a little bit of a backing off. And we had a risk fear premium in oil, $3, $4 a barrel with Russia. We had 1 or 2 days where they said Russian troops were moving off the eastern front of Ukraine, but that proved not to be true data. But anyway, energy fell a little bit for the week, but it's still leading the way year to date, 22.6% roughly. Real estate bringing up the rear as the 30-year mortgage rate saw the rates move, slightly over 4%. So, obviously real estate's going to fill that hike as well. We're also getting the idea that the Fed fund futures after the meeting minute notes hit this past week. You can see from an economic data standpoint that the probability of a 50 basis point rate hike in the next Fed meeting, which isn't until March, has been reduced. And now it was over 60% with a 50 basis point rate hike, a 0.5%. Now it peeled back to 25 basis points. There's like an 80% chance of 25 basis point rate hike in March, primarily because the Fed meeting minutes from the prior meeting in January showed they're still leaning on the dovish side, which is kind of what I expected. So we're seeing some of that as well. Okay. Now understand, in the U.S. Treasury market, for every professional prognosticator or guru or whatever you want to call them on TV that are talking about a recession is going to be inevitable, there are others that are predicting that the Fed can combat that without reversing economic growth, right? So there's a disagreement big time over the inevitability of a recession, right? And we've got all these varying views out there about the frequency and quantity of coming interest rate hikes, the Fed's plans for and ramifications of shrinking its huge balance sheet, after they put 5 trillion into it. Remember, the balance sheet is over 8.8 trillion. It's huge. It's a record, right? We got a record 30 trillion in public debt. It's up about 30% since 2020, since COVID. All right, that's the public debt side. Some estimate it's probably even more than that. So even with rates topping out over 2%, that's going to translate into an extra 600 billion a year in interest owed by the U.S. Treasury. So it's just, they're in a really difficult situation. I think economic growth is going to be really penalized here over the next decade as they figure this out. And in fact, I was talking to an analyst buddy of mine who works for a major hedge fund. They can model in interest rate hikes. They can put in, 1%, 2%, or 50 basis point interest rate hike and figure out using discounted cash flow metrics where the PE ratio should come. But what they can't do, and what they have a hard time doing, is modeling if you take 100 billion or 200 billion off our balance sheet, what will quantitative tightening do? And the main reason why is a lot of it's market driven, right? Because remember, when the Feds are not buying as much, someone else has to step up to the bar and buy in lieu of the Feds. Other sovereign wealth funds, other banks, other countries. And if they don't buy in the quantities that are needed, then interest rates are going to go up because they're going to demand a better price for the bonds. That is a market force. So that is very hard to model. And what they'll do is they'll wait until the Feds start cutting by 20, 40, 50 billion a month and see how the markets react to it. So there's a lot of unknown sitting out there in this market, really unknown. And that's primarily the reason why you're seeing the NASDAQ and the FANGs. FANGs actually moved into a bear market. I got a customized FANG index, which I'll show you. They're in a bear market, but NASDAQ is close to a bear market. The Russell, close to a bear market, right? Really ugly, ugly, ugly. All right. Now, if we come over and we look at the European markets, well, they didn't have a very good week either. All right. Over in Europe, European stocks, Euro stocks is 50, the largest companies all across Europe. The FTSE, which is the London index, CAC 40, the French, and the DAX, which is the German index, all in the red. The only one in the green year to date is the FTSE, right? I mean, they're kind of the last holdout. Now, keep in mind, the Bank of England, they have raised their rates 2 times already. They've got, we saw UK inflation come in at a 30-year high last month in January, right? As their labor market's tightening even more. So that increases the expectation of a 3rd rate hike in March for the Bank of England. Consumer prices are up over 5.5% over year basis. So that's the highest level we've seen in the UK since 92, right? So they're under severe pressure. But they're hiking the rates, and year to date, the FTSE is the only one in the green. Okay. Meanwhile, over in Europe, the ECB, the president there, Christine Queen Bee Lagarde, who is running that place usually by consensus, emphasized an adjustment to monetary policy would be gradual. So we've got the UK hiking, leading the way actually. Queen Bee Lagarde is just slightly more dovish than the Feds here, but still talking about hiking rates this year, all right, kicking things off. And then, of course, if we look at the Asian markets, China was the only one up for the week, and then the Hang Seng down a little bit. Hang Seng's green year to date, but China is red year to date. China almost went into a bear market last year, so you can just kind of view these as just bouncing off the bottom, really. Okay. Chinese markets are also up because unlike the Bank of England, the ECB, and the Feds here in the US, Chinese markets and the Japanese markets, the banks, the People's Bank of China and the Bank of Japan, they're the only ones actually easing, putting more stimulus into the economy. All right. So, and we did get the PPI numbers and the CPI numbers out of China. They came in a little bit lower than expected. And their inflation's coming in a little bit. So that gives the their government's a green light to put more money out into the economy. So that's why they're kind of holding up a little bit right now. But keep in mind, they're scraping off the bottoms from last year, almost running into a bear market. Okay. So that's a little bit about what we're seeing here. Just one other little chart I wanted to show you. If we look at this, you can see here since 1920 for the S&P, you can see every decade, and you can see in red those decades coming off the 1929 Great Depression in the U.S. and then the dot-com bubble and the 07-08 financial reset in the U.S. Those are the only 2 decades where we actually had underwater performance for the entire decade. You can see the number of bear markets in each decade. We've averaged roughly about what 2.3 bear markets every 10-year period, which works out to about a 20% probability of a bear market in any given year. Right? And so you can just see the data here. So having a bear market should be expected. In fact, it's a way for the markets, kind of like clearing a fire lane for brush fires, right? You want to clear out some of the trees and driftwood so that you don't burn everything down in the process. So I suspect over the next decade, we're going to see periods where we have some really ugly times for the markets. For those of you that understand options, it's going to be a good time. We're going to have some really great opportunities here in these markets. By the way, if you're not a member, I highly encourage you to come in. We're in the green this year, doing well. Last year was a good year for us. This year we've started off good. And we've added to our chat room, we've added a automated secret trader room that automatically does auto trades in the SPYs and the Qs. And then over the next 90 days, we'll probably add about another dozen or so key stocks. So following that, using option strategies for people that just want to do that. They're basically swing trades from intraday to, 5 to 7 day trades that tend to work out really well when you have higher volatility because you get really short trends that just bust a move up or down, and it'll get you in those trades if you're interested. But anyway, that's kind of where we're sitting right now. What I'm going to do is just quickly take you over and show you a chart here, or some charts. And while we're going to wait for the charts to come up on the screen, keep in mind Monday is a U.S. holiday, so all markets will be closed. But as usual, the futures market will open on Sunday evening at 6 p.m. Eastern Standard Time, and then close the next day. Probably around 1 o'clock in the afternoon Eastern Standard Time, and then reopen again Monday evening at 6 p.m. again. But equity markets, U.S. equity markets, bond markets, everything will be closed. Now, let's look at the major indexes in the U.S. Every single one of them is damaged severely, meaning prices below the 50 and the 200 EMA, both the 50 and the 200 EMA, but primarily the 50's got a downward trajectory to it, or a vector. You can see where we're sitting right now. We're just off the lows that were made in 2022. Actually, it was made the third week in January on the 24th. You can see it was down around the 42.12 area. Now, as I told our members, I believe the markets will come down sometime over the next 3 or 4 months, and we'll find a 3,800 level on the S&P. Right? That puts us down just right at bear market territory, give or take 50 points or so. I'm not, and I don't put it greater than 50%, but I can see the odds favoring that at this time. Okay, probably around 40% probability right now. But you can see where we're sitting. All-time highs were made on January 4th, and then away we went. This line here just separates markets being in the red versus markets being in the green. And the big question everybody asks for 2021, or 2022 rather, is that have we already made the highs for the year, right? Because the high was made on the 4th of this year, January 4th, and now we've just been coming down. Now, so if we look at the S&P, and then we'll take a look at the Dow too. The Dow is actually the stronger of the two, but you can see here, the Dow is only down in correction territory for the year, 10.3%, but you can see again, well below the 50 and the 200, okay? Overhead resistance is going to be the 200 EMA for all indexes right now. We're down below both. But look at this one. This is ugly. This is the NASDAQ 100 futures. I mean, not only is the 50 EMA got a downward vector, but so does the 200 EMA. And you can see the low for the year in the NASDAQ 100 futures. It's 100 of the largest companies, tech companies mostly, in NASDAQ. It was down 18.25%. I believe we're going to challenge that number, maybe move move lower than that, down more. Okay. So I can see that playing itself out here. Okay. Again, you can see here we could get a cross in the 15 to 200 called a death cross. If that happens, that also tends to be a very strong magnet for prices to come back to at that cross, but then it's resistance and it rolls back over. As I told our members, the 200 EMA and the 50 EMA is going to be resistance points. Typically in a bear market, price goes down and then we have bull trap rallies, counter cyclical rallies. In this case, a counter move would be bullish, run it up to the 200 or the 50 EMA, and then it runs out of steam and it rolls back over, much like it does here. We're looking for follow through. When we hit, depending on the index we're looking at, we want to see follow through when it comes over. You can see here, every time it hits the 200 EMA, you get a green bar, but then the very next bar is a red bar and it comes back down again. Folks, that's bearish. That's not bullish. Okay. And I'll show you an even worse chart, which is the Russell futures. You can see here with the Russell, we actually moved in a bear market territory, the Russell, on January 28th. And now we're rolling back over again. I suspect we're going to take that out. Remember, the Russell tends to lead a bear market into a bull market because it's usually small cap growth, mid cap, and a combination of a number of smaller stocks. So, and typically it's kind of viewed as a risk on, risk off type of index. And when the markets start getting ugly, money comes out of there. Okay. From at the index level. So you can see here where not only do we have a death cross where the 50 is below the 200, but we also have price action below the 50 and the 200. So folks, that is a bearish, this is a bearish index chart. Typically in a bearish index chart, as you can see, when we come up at that cross level, it tends to be a resistance zone. You can see right here, a lot of resistance, and then we just roll back down again. Until we can actually clear the 50 and the 200 and see it hold, we're going to be in a bearish mode, folks. And if I show you the FANG index, this is the index of the largest, or this index here is a customized of Microsoft, Facebook, Apple, Netflix, Google, and Amazon. Facebook's having a number on this one. Facebook's just cratered, right? It's down, almost 50%, I guess. It's just really gotten hurt. But notice in the FANG index, we've got a death cross that's set up here in the middle of this past week. We're going to come down, challenge these lows, and probably move even lower. So money is clearly coming out of the tech sector. There are certain tech stocks we want to look to buy. Members, I'll review that with you in our next session, but just understand that there are some tech stocks that you want to take advantage of this move lower and pick up over the next 5 years or so. They'll do very well. Now, if we come down here and we look at volatility, you can see the VIX right here. I have my charts coded, as you can tell. We're in this down fast market mode right here. And we're up at the upper boundary of this before we move into a market correction. So I suspect we're going to do that, move back into a correction. And then, like I said, over the next 90 days, going into early May, we have the odds of coming down to 3,800 in the S&P, right? So that's kind of what I'm looking at. And that puts us right on the precipice of a bear market. Will we hit a bear market this year? Hard to tell. It's just I wouldn't even pretend to pull out the 8 ball and see, because by the same token, if Russia backs off, they don't invade, which I think the probability is. I'm kind of go against the wind and the tide. I don't believe they're going to go in. I know a lot of people are doing that, but I just think it's all propaganda. I think he's got more risk to go in than he does to stay out. So I think he's going to stay out. But where we got the big risk is we're winding down the earnings for Q4 2021. Which means markets are going to go quiet until the next Fed meeting in March. And when you leave the markets alone, that's like leaving 4 or 5-year-olds alone in your house. They're going to tear everything up. So there's a lot of speculation on what they're going to do, how they're going to do it, how they're going to cut the balance sheet, as I said earlier, how they're going to raise rates, what's the speed, what's the trajectory. And markets left alone tend to move a lot wider dispersion than when they've got a general idea what's coming. Okay. So you throw that out there, And I just think it's just we could have a rally, a pretty good sizable rally before we roll back over again. So this is kind of what I'm looking at right now. Okay. And then keep in mind, as we go through March into April, then we're going to get Q1 earnings. And Q1, the year over year comparables or the comps to Q1 of 2021, they're going to be a lot harder. You're going to see slowing growth. You're going to see everything coming down. And if inflation stays sticky, which I believe it will, for another quarter, you're going to see the gurus coming out and all these other talking heads on TV talking about raising the rates at a faster clip. I've seen everything from Goldman Sachs saying 7 rate hikes to others saying only 3. That's a wide dispersion, and that creates a lot of volatility in the market. So we got that to look forward to. For the Treasury market, well, we follow this extremely close, right? You can see the Treasury move here off the lows. As you guys know, I'm more of a bear in the Treasuries. We've been in a bull market in the U.S. Treasury market here since really the .com, or actually for 20 or 30 years, we've been in a bull market. But I think eventually we're going to roll over. Okay, so any move up higher here is going to probably be met by selling, and we've got trades on that play this longer term. So, members, we'll stay abreast of the credit markets and treasuries to try and get an idea of what is in the mindset of the Feds and the central banks here and over in Europe, just to see what's going to happen. We've already got trades playing in the currency market, primarily with the dollar and the euro. I've given you my opinion on that, especially with the members. But I do believe longer term, the dollar is going to roll over and the euro is going to get stronger. Okay. And if we come down here and look at metals, I've already recommended some calls in gold and a way to play gold. You can see this high move here. I didn't even have a chance this weekend to adjust it, but you can see gold had an intraday high here of 1905. Okay. A little bit of a pullback would be expected, but I think gold, we're playing this, by the way, to the long side this year. All right. And there's a number of different ways to do it. I also like silver. All right. Silver is another one. This is silver futures. You can see here, I think silver futures is going to come up and challenge this 2022 high. Notice here with silver futures, the 2022 high was made back in January. Right. So we're not anywhere near that. We're looking to challenge the 200 EMA. Notice here we failed the 200 EMA. And if we come back to gold and just look at gold, you can see here we're already, in fact, this past Friday, we made 2022 highs. So silver is trailing gold, which is typically shows there's a lot of fear in the markets right now, which we'd expect with Russia and Ukraine and you know all that stuff going on over there. So typically when there's fear in the markets, gold will lead silver. But when things settle back down, you'll see silver hold its own a little bit better than gold. And longer term, I think silver will pass it. Okay. And then, of course, if we look at oil, I think oil will eventually hit $100 a barrel. The demand is still outstripping supply. A little bit of a pullback is in order, and I had suggested a way to trade this for our members. I would stick with that trade. I think it'll work out really well for you. And you can see here we're up near 2022 highs. All right, so I tend to be neutral, bullish gold or oil right now. Now, should they invade Ukraine and do an official, I don't know if you make it official, but they'll come in once they put boots on the ground in Ukraine and you see tanks blowing across fences and things like that, oil will quickly get over $100, $105 a barrel. It'll be boom, it'll be up there very fast. So if they don't invade and you see them backing off, you'll see oil come back down in the low mid 80s to upper 80s, just as a reflex move, and then it'll kind of settle in there for a little bit and then gradually move higher. All right. So that's a little bit of what I'm seeing with oil. And then, of course, nat gas. As you guys know, anytime nat gas has had these spikes, I love to short it. And that's kind of what we're doing. Right now, I wouldn't play nat gas either way. Right. I just wouldn't touch it. So, folks, that's a little bit of really quick and dirty of where we are this week with the indexes. Everything is not looking very pretty. Members, we've got an option masters tomorrow evening as a reminder. So I will get out there for you guys. I'll get an invite out to you guys tomorrow, and we'll cover ways of trading an asset long or short, some really simple ways of doing that using options. So we're kind of back to the basics for a lot of you. Otherwise, have a really great weekend, everybody. Enjoy the holiday weekend for all U.S. citizens. Everybody else, have a great one, and we'll see members tomorrow evening. Take care, folks. Ciao now.